net present value will always give you the right answer because we're using the correct cost of capital value of cash flows. Internal rate of return is a very good approach to give you a single percentage interest rate return on an investment, but it can be misleading in that a 21% project may not be as good as a 19% project, where we define a good project as being the best project is returning the most value in terms of the actual present value of the project. But it's very, very popular method. We have to talk about it shortcomings and how to get around the problems. So let's talk a little bit about this process. And we'll start by just sort of looking at the alternatives and trying to decide what to do. But this, again, we'll spend most of the time on the evaluation techniques. First of all, it's probably best to look at the alternatives that you've got and decide which ones are feasible. Less work is always preferred to more work. And if we can take a bunch of the alternatives off the table because they're unfeasible, then we don't have to analyze them. And so let me define a few terms here, and that's really what this is about. Let's say I've got 3 proposals. Well, there's 2 to the end or 2 to the third ways of arranging. So we've got 8 alternatives to have a look at. But not all of them may be feasible. For example, if I have these proposals, and those are the 8 possible arrangements, let's say I have budget constraints. I can't afford all 3. So any alternative that has the first cost being greater than my budget will basically eliminate. In this case, I can't afford all 3. So alternative 8, we're not going to do. Now, normally that's not the case because when we think about going to the market for money, if we have good projects, the rate of return is higher than the cost of capital, we generally can raise as much as we want. There's just sort of an infinite supply out there in terms of our demand on the marketplace with companies. But sometimes management can say, well, we can only swallow $100 million worth of investment this year, that's where we're going to stop. Even though there may be projects that have a rate of return greater than the cost of capital, but that's what we're going to start. That's what we think we can manage. So budget limitations are capital constraints. Mutually exclusive refers to projects that are competing. They do the same thing, but they're basically different ways of accomplishing the same goal. I've got 4, let's say, proposals to put in a computer center for our data center, and I've got 4 different vendors. I go to tender. I only need 1. So those alternatives are mutually exclusive. I'm going to choose the best one only, because I only need 1 computer center. And the final possibility is that of contingency. Let's say I've got these 2 computer designs, 1 and 2, and let's say one is a networking system from Cisco, the other one is from IBM. But there's some very, very specialized test equipment that only works with the IBM system. Right? So 3 is basically this specialized IBM test equipment, which of course won't work with the Cisco system. Right? So if I'm going to evaluate that networking test system, I have to do it only when I'm looking at the IBM alternative. So 3, the networking test system, is contingent on 2, the actual networking system from IBM. Okay, so I need to consider all of these things, and if I do, I can get rid of 4 alternatives right away. I can say, well, I can't afford them all. I don't want 2 of the same thing, and any alternative that has the IBM test equipment associated with different than IBM equipment is also not feasible. This won't work. So essentially, I've got these 4 alternatives, and that's what I'm going to do. Now, alternative 1 is sort of interesting. It's to do nothing. So if all of these alternatives have, let's say, negative net present value, well, I'm not going to do any of them. I'm going to choose to do nothing. Do nothing is always usually valid, except in a mandatory situation. Let's say I'm looking at a project that's mandated by the government for pollution control. Well, do nothing is not an option. So I'm going to choose the one that costs you the least amount of money. Sometimes do nothing is not one of my options. Okay. And it'll make analysis actually easier in terms of looking at mutually exclusive alternatives. Okay. So first of all, just step back and say, well, which of the alternatives are really feasible, and then spend your time analyzing them. Okay, let's say we've got a number of alternatives. What do? Well, we want to value the benefits, right? We know we've got a capital expenditure now, and we ask the question, well, what are the benefits? Well, over what window am I going to look? And a good window to look at is tying it to the economic life of the asset. Remember, definition of functional versus economic. Functional is, well, the car's going to run for 10 years, but it's going to be so expensive that I want to get rid of it after 5. And we'll talk about actually calculating the economic life in Chapter 4. So the economic life is 5 years. So for a piece of engineering equipment, if it's 5 years, that's the planning period. So we'll look at the investment and we'll measure the benefits of that investment over the economic life. Well, that gives us a problem if I've got two, let's say, mutually exclusive alternatives, and one has a piece of equipment that has an economic life 5 years, and the other 7. Well, what do I do? Well, you might say, well, you know, NPV process, it always gives you the right answer, so why don't I do this? So I've got alternative 1, and I'm going to buy something, and I've got basically 5-year life. 1, 2, 3, 4, 5. Where, of course, the reason I'm doing it is for net cash flow. Right, so think about this as being R minus A. The revenue of the project minus the cost, again, on a cash basis, right? And so, okay, fine, NPV 5. Well, what about this? The other alternative, NPV 7, looks like this. Now, can I directly compare them? Well, think about if I only have a cost situation, so all they're negative. Am I not saying, well, NPV 5 is what it costs to run the thing for the next 5 years, and NPV 7 is what it costs for the next 7? I can't directly compare that because usually running something for 5 years is going to be cheaper than for 7. So it's not an apples-to-apples comparison. Right, so it's not going to make any sense to just directly compare the NPV. Well, how do I get around the problem? Well, I want a comparable planning period. And so the easiest thing is, this is in the textbook, it's called the classic approach to project analysis. It's the least common multiple. Why don't I just say, well, what's it cost to run this thing for 35 years? Well, then I've got 7 cycles of this, 5 cycles of this, and it's coterminous. And then I can do NPV 35 of both and directly compare. Now, that's technically or theoretically possible, but think about whether that's meaningful. I mean, our game in information technology is lucky you get a second cycle to look like the first cycle. Like, costs are always changing. So it makes absolutely no sense. So theoretically, yeah, sure, NPV 35 you compare. So I'm going to do that. What I need to do then is take a practical approach. What's the first approach? Well, let's ask the question, what does it cost to run both these projects for 5 years? And so I'll have a shorter project life. Well, the 7-year piece of equipment gives us a problem in that it's still, I should actually put salvage value here. So let me put S5 and S7. So the salvage value of the equipment, if I hold it to the end. Well, do I not, if I truncate this project after 5 years, have a piece of equipment that has still a useful life? And the answer is yes. It still has 2 years worth of useful life. So if I want a direct comparison, maybe what I need to do is to estimate S prime 7. In other words, wrapping up the 7-year asset after 5 years. And what I'll normally observe is that S prime 7 is greater than S7. Right, a machine that's worn out, end of its life, is going to be worth less than something that has 2 years worth of value. If I do that, I now have a 5-year comparison, apples to apples, and I can say, well, which one's best? So that's sometimes very pragmatically what we do. The other thing is, well, let's say, well, you know, that's a good way, but I really don't want to disadvantage this project by wrapping up that asset with 2 years worth of useful life. That isn't appealing. What do I need to do? Well, perhaps what I should do then is to say, let's have a 7-year planning period. So my planning period now is 7. What do I got to do? Well, I have to look at this asset and say, let me reinvest and run it for years 6 and 7. Right. And then I've got basically a direct comparison. Now remember, in our engineering analysis, we generally ignore inflation, right? Because we're using the real cost of capital from our inflation discussion. So if I could purchase this basically at the FC5, first cost 5 here, then since inflation is ignored, I can buy it again for the same price, run it for 2 more years, and then of course I'm going to have a salvage value. This is going to be S prime 5. And what does that represent? the value of a machine, it still has 3 years worth of useful life. It's a 5-year machine. Okay. And again, I can say, as times 5 is going to be greater than 5. And I can estimate that and then do a direct comparison. So with the economic lines being different, I've got a little bit of a challenge in deciding what is the planning period. In very practical terms, what most companies do is what I've indicated there, a standard planning curve. One example, I'm familiar with Bell Canada. And they have an engineering economic group that basically gives guidance to their engineers in looking at the finances of their engineering projects. And so that's the approach they take, and the standard planning period looks something like this. If it uses computer equipment, 3 years. If you've got a larger project in telecommunications, so you've got a telecom project. For example, you've got a telephone switch, or some networking equipment. 10 years. The equipment has a 12-year life. Well, wrap it up after 10. Okay. What about projects that use fiber optics? What do you think? Fiber lasts forever, right?
20 years? 20 years?
20 years? Pretty close. 25. Okay. So you're actually going to, if you're looking at replacing copper, you're going to actually mine all the copper out of the ground, right? Because copper is worth an awful lot. So you still have all the old wire. That's one of your sort of sources of revenue for the project. And then you evaluate having that fiber equipment there for 25 years as opposed to, let's say, running some more copper. So 25 years. Okay. And so as engineers then, we don't have to worry about it. This is what we do. We estimate the economic life of the underlying assets and then decide what to do at the end when we have to truncate or reinvest to meet these time periods. So it's pretty straightforward. And again, the key thing is we're ignoring inflation, right? We're using real cost of capital and analyzing this. So if we have to reinvest, we don't have to worry about prices going up. Okay. So, planning period. Okay. Now, is the planning period, can it really affect our outcome in terms of what we recommend? And I'd like you to think a little bit about, looking at the planning period and trying to decide, well, is it really important? I've got an example here where it shows you that indeed the assumptions that I make can affect the outcome. I've got 2 mutually exclusive alternatives. Or I've only got enough money for one of them, either way you want to look at it. And if I look at the nature of the projects, they can either be one shot. So let's say, both of them might be a coal mine, right? Once you extract all of the ore, that's it. You can't reinvest. Okay? Or it could be equipment in a mandatory service, okay, where I can buy the equipment, 5 years from now or 4 years from now, and continue to run the service. So the first example I want to do is as, let's say, a coal mine. It's one shot. And I'm going to look at it from a 6-year point of view because it takes 6 years in alternative 2 to extract the ore. Whereas in alternative 1, it's a little bit different. And so, after year 4, in alternative 1, there's no more ore down there, and so, there's no more revenue. If I use a 6-year period, I'm going to value these cash flows. And remember, I can either do it at present value, or in this case, I've used FW or future value. It gives me the same recommendation, right? Because remember, there's only a P given F or an F given P to adjust between one or the other. So here I'm saying, how wealthy is the investor going to be from both of these at the end of 6 years? And remember, when you do future worth, it's above the opportunity cost, right? So if those numbers happen to be 0, it means the investor is returning exactly 10%. If it's greater than 0, it means greater than 10%. Okay. So in this case, there's value beyond the opportunity cost, and if I just value these cash flows using my formulas, it's going to recommend alternative 2. Okay. So there's a greater value in alternative 2. And this is assuming I can't reinvest. Okay. Coal mine, I can't put the 4 down there after 4 and remine. Okay. Now, does the outcome change if rather than being one shot, it's a mandatory service? So think about this example now in terms of, let's say, a phone company, and they have to provide phone service. Well, Let's choose a 6-year planning period. Okay. So alternative 2 is done, and I've got a future worth of $16,000. In alternative 1, yes, I could run the equipment for another 4 years, but since it's beyond its economic life, it's either not working very well or it's too costly. So what am I going to do? Well, I'm going to have a reinvestment. So think about the cash flows as being what they are for the first 4 years. It's at the end of the economic life, and so I'm going to reinvest. Well, what's the equipment going to cost? Remember, no inflation, right? $4,000 again. And we are going to say, well, the cycle is going to repeat simply because it's the same equipment and there's no price adjustment. So I'm going to have for years 4 and 5 this. My problem, of course, is that it's a 4-year machine, and if I truncate the project after 6 years, I have a salvage value, which is reflective of the fact that the machine still has 2 years of useful life, so it's not scrapped at this point. You have to estimate it. In this particular example, I believe I've estimated at $1,000. So now I'm going to ask the question, well, what's the future value of this with the reinvestment? Because now I've got equipment to run the service for 6 years, which is what I need to do. That's my mandatory part of it. And I get a different number, of course. And in this case, it's greater than the equipment that has a 6-year life. And so the alternative that's preferred has changed depending on the underlying assumptions of the nature of the project. Alternative 1 in this mandatory service situation is the better one. Okay. So, some of the strategy going in is, think about the nature of the project, what you have to do, whether you have to reinvest or not, or whether you can. Okay, so, one shot versus mandatory. Okay. So, the actual assumptions regarding reinvestment can indeed affect the other one. Okay. So, we've got this planning period, which really is a way of looking at the revenue stream that's generated from the project. And again, it's cash. Right? Investors are looking at the cash that's returning. And so what we want to do is look at the net cash flow. It's revenue minus costs, or benefits minus costs, whatever term you want to use. And so all this slide is saying is, we're going to look at that investment at end of year 0, and then we're going to look at the revenue stream that's coming back, the stream of costs associated with generating that, and look at the margin. And that's what we're going to value. And so one can look at it individually, or one can look at it incrementally. The delta net cash flow is the difference between B and A in terms of NCF or net cash flow. Okay. And so, what we can say is, when I'm looking at B versus A, this is how much better B is each year in terms of the revenue stream, cash flow that's generated. Now, key thing, and quiz 3 always has something, or some extra words regarding depreciation when you're looking at this. Depreciation, is it cash? Answer is no. Is it relevant? Absolutely not. And so, if I'm looking at a cash flow analysis before tax, I'm going to not consider depreciation. Okay. Well, you say, well, depreciation is important, and accountants worry about it. Well, the answer is yeah. However, think about from a cash flow point of view. What am I doing? Well, I'm buying a machine, right, first cost, and I'm keeping it for the economic life, let's say 5 years, and I'm salvaging. That's the cash that's involved in terms of the capital asset. Now, of course, accountants are going to say, well, we've got to do things on the income statement each year, like on quiz 2, and so we've got to come up with some number that's the cost each year. That's a number. It's not reflective of any cash. It's an allocation of this first cost. Right? Not relevant in a financial analysis, but I'm often asking, well, how much extra cash is coming into this company each year? So all of the cash element is basically subsumed in these two numbers. Okay? And depreciation or any allocated costs or these sorts of things that are not cash are irrelevant. Okay? So just keep that in mind. Okay? These two are the relevant capital cash. Okay, so we've got some alternatives. We've got a window within which to measure them. We've got the cash that's being generated. So now we have to say, well, how are we going to trade off that initial investment versus the net cash flow over time? And this is where, obviously, the time value money comes in. Well, what are we going to use for time value money? Well, we talked about cost of capital. And that's the key thing here. I'm going to look at what I call, the textbook calls the MARR, the minimum attractive rate of return. That's essentially the hurdle rate. I've got to do better than that, or else investors can go elsewhere and get at least their cost. And the key thing through all of this is this opportunity cost notion. Right? We've got this, we're being measured against what investors can do elsewhere. And that's what really these investment techniques, evaluation techniques will look at. So quite simply, net present value greater than zero, project is worth doing, it returns greater than the opportunity cost. Now, key thing here is, think about this notion of opportunity cost and how it affects us as engineers. Okay. Obviously, if we have to go to the market and raise debt and equity, there's a real cost. And so, saying that the cost of capital is, let's say, 12%, and I have an 11% project, I'm not going to do it. But 13% project, I am. Now, think about the way that we can fund a project. Okay. Think about this notion of retained earnings. Okay. If I have profit left over and I've decided not to give it as cash dividends, it stays within the company. Is that money free? Okay. Let's say I made $1 million last year, and my option is to pay out $1 million worth of dividends, or to keep $1 million in the company, and I've got this wonderful project that I can spend $1 million on. Cost free, because I don't have to go out to debt and equity to raise it. It's sitting in the bank account as a result of making that profit. Okay. Now, let's say that my cost of capital is 12%, and the boss has this pet project that's returning 8%. Is the company better off taking this 8% project? Think about it. First thing I can observe is, well, what is it going to do with the $1 million? Well, it could put it in the bank account, earn 3%. But the boss has this 8% project that's going to be better than putting the money in the bank. Should we take it? 2%, 8%, 12%. What do you think? Any thoughts?
We'll need to look at the curve that you showed last time.
Okay. So let's have a look at this thing here. So I think this is what you're referring to. This is basically the dollars, and this is the K. And so the market's going to give us, let's say, 12%, and it's going to come out like this. Okay. And I'm just going to say, for $1 million, we're here. So I can go to the market and get 12% money. Okay. But I have an 8% project. And I have $1 million worth of retained earnings. This is cash sitting in the bank, because I chose not to pay the dividend. What am I getting on that? 2%. Right? Any bank account pays 2 to 3%. Okay. Do I take the 8% project? Does that make any sense?
Well, it actually depends on if you're not raising better to it. If you have nothing to do, then you can take 8%.
Okay. So one suggestion is, very astute observation, if I'm making 3% in the bank and the boss has got an 8% project, aren't we better off taking the 8% project? It would seem so. Counter argument?
It also depends on the risk of the 8% project.
Okay. It's going to be a little riskier than putting the money in the bank, but it's a pretty solid project. So let's say there's no risk premium. Okay. But you're right. If it was a really risky one, then perhaps the 5% premium is not good enough.
Do we have to look at how long the project takes, and then maybe next year there's a better project? So it's
okay.
better to save it right now for.
So keep it in the bank for a year at 2%. Maybe something comes up. Maybe. But, you know, what do I do today? Who's the boss? Isn't the shareholders? What's the shareholder going to say if you take $1 million and keep it in the bank at 2%? They're not going to be happy. What about if you put it in an 8% project? Well, isn't the fact that our cost of capital is 12% reflective of the fact that investors have that as an opportunity cost? In other words, there's other places they can put the money than our company. shouldn't we just give them that $1 million back as dividends? And then because they've got other places, other companies to grow it at 12%, they will be happier. So the line up there that says, even if the funds are raised entirely from internal sources, that's just another way of saying retained earnings, I have to still use that same cost of capital. Because the investors, again, it's their opportunity cost, they can invest at 12% elsewhere. They're not going to be happy if we take the money and put it at 8%. Okay. So essentially what I want to do is I want to give them back that $1 million in dividends. They're going to go to some other company at 12%. And my boss's pet project at 8% won't get done. Okay. So it's irrelevant where the money comes from, because no matter whether we go to the market and get it at 12%, or whether it's internal, investors, if it's internal, would not want us to take a project less than 12%. Because again, they can go somewhere else and do that. Okay. So that's the rate we're going to use for, let's say, normal business risk project. Okay. And then, you asked about the risk factor. Well, of course, investors want a risk premium if we're taking risky projects. So sometimes, even though we've got, yeah, please, was that a stretch?
Oh, no, that question. Like,
yeah, please.
If you don't have any other projects that are returning greater than 12%, then your company is already going down with it.
Well, not necessarily. Let's say one of the areas where any company that pays most of their profits as dividends is a company that doesn't have much opportunities. So think about like a large national grocery chain. Okay, they have stores everywhere they want, and they're making lots of money. So what do they do with the money? Well, they're not going to put up in a second store in a city where they can only justify one. They basically give all of the profits back as dividends to shareholders. Okay. So if you've got a really good business model and there's no room for expansion, you don't need the money. And there are lots of companies, lots of investors that say, that's my type of company. Right? There's no risk. They're paying dividends, large dividends every year, and I'm happy. Okay. But if you're a high-tech company and you have no place to put your money, it means that probably, your management's asleep. Or even worse, your engineers aren't doing their job. Okay. But there are businesses that are established and pay most of the money, most of the profits as dividends. Okay. So if we're looking at the risk factors, let's get a notion of our project to see whether or not it is riskier than normal. And so if I'm doing a replacement analysis, all I'm doing is spending money to save money. Very, very predictable. Well, maybe I need a slightly lower rate. But what's more important, if I have a speculative project, I'm going to have a higher rate because there's a lot of risk associated with it. And I want to capture that in terms of the investors wanting not to take their normal business funds and earn 12%, but essentially 18%. Okay, we'll talk about this in chapter 7. For purposes of 4 and 5, there is no risk because there is no variability in cash flows. Therefore, we're going to use one number, in this case, the normal business risk of 12%. Okay, and then relax that assumption in chapter 7. So if there's a cost of capital, no matter where the money comes from, that drives the entire analysis. And what we usually assume is that we're somewhere in this region here, where it's just a constant number. And that's it. Okay, so that's basically, we've got the alternatives, we've got a window, we've got a time value money, and now we have to figure out, well, how are we going to do it? What's the measure? And these are the ways of possibly investing and evaluating investments that are used. What we'll focus in on really are two of these. The cash flow value, which is mostly present value, okay, and the internal rate of return method. So those are the ones we're going to really cover carefully. Payback period, used for inconsequential investments. If I have a tool, costs $500, I do a back of the envelope calculation and see how quickly it pays back. Okay, not much to it. Savings investment ratio method, that's another way of really saying the cost-benefit analysis that's used in public engineering projects. So we'll save that for chapter 6. Okay. And that's a method that looks at a ratio of present value benefits versus costs. External rate of return, not really used. It's a modified version of 3, which has some different assumptions. I will just talk about it because it allows us to deal with some of the issues in the internal rate of return. Okay. So essentially, 2 and 3 we'll focus in on. And present value is virtually the way that we do it all the time. What's the present value of this project? That's what we look at. Annual worth is used for one way of looking at economic life. Okay. When I'm looking at economic life, I want to figure out a cost per year so I can minimize that cost. So that's the only exception in terms of the valuation being present value. So if you have an economic life problem, you're looking at annual worth. Virtually anything else is present value. So that's what we want to talk about. Okay. Well, let's first of all talk about this payback. Okay, just one slide on this. Really simple method, any manager can figure it out and basically do an analysis. Example is probably the easiest way to deal with it. I want to take any investment that pays the investment back within the company's payback period. So let's say this company says, well, we take all investments that pay back within 3 years. And let's see why it's not a great method in terms of deciding what to do. Got a $1,000 investment, and so if I look at the two mutually exclusive alternatives, I only want A or B. Well, in terms of A, if I add up the first 3 years worth of cash flow, I've got something that's greater than $1,000, $1,200, and therefore I'm going to take it. And if I look at project B, well, I'm going to reject, right? Because I've only got $600 coming in 3 years. Now you might say, well, time value of money means that B probably isn't worth doing, but look at the very substantial cash flow. Okay, where in A you're getting absolutely nothing. The only way I can see whether or not that adds enough value to flip it in terms of B is to value it at the cost of capital. So this method doesn't consider time value money at all. Okay. And so I'm going to totally ignore the fact that this project is a real late bloomer and it may be really good for the company. So there's no time value money, and therefore it'll be biased against, it'll favor, let's say, quick returns. Okay. Also, no time value money basically suggests that if I have a project that returns funds early, it's not going to take precedence over one that doesn't. And really the real example here is both of these return greater than $1,200, greater than $1,000 in 3 years. So X or Y, $1,200 in 3 years. This method says, well, I don't care which one I take, because according to the method, they both achieve the objective. Well, of course, this one is better than that, right? This one has a greater present value. The cash is coming back soon. So no time value money really leads us to a decision that may not be what we want. When is it used? Well, say if I have a $1,000 investment in a tool or something, if it returns in 3 years, that's all the analysis I'm going to do, and that's good. But if I'm putting $1 million in a strategic project, I'm going to use the time value money. I'll use net present value or internal rate of return. One point where this is useful is it's an indication of risk. And we don't talk about risk really until Chapter 7, but let me just, because we're on this topic. If I look at a project, I have two alternatives. And let's say my return is 12.3% and 12.5%. Okay. And let's say the cost of capital, K, is 10%. Okay. The first thing is, if they're independent, both are greater than 10%, both are worth doing. So if they're independent, A and B. What about if they're mutually exclusive? They're competing alternatives to do the same thing. Well, 12.5% is better than 12.3%, so I'm going to choose B. Okay. What about if I give you this additional bit of information? Payback. Let's say the payback period on this is 8 years. And the payback period on this is 3 years. From a pure financial point of view, B is still better than A. But do I necessarily want to take B? Think about how, I always like to say, the longer you wait, the more bad things that can happen to you. I.e., the risk is higher. Right? So if I have a project that takes 8 years to get the majority of your money back, over 8 years there are far more bad things that can happen than in project A, where I'm getting the bulk of my money back in 3 years. So from an economic point of view, I might say B is better than A. But from a risk-taking point of view, I may say A is better than B. Because what am I doing? I'm trading off 0.2% return and waiting 8 years to get the majority of the cash back. So payback sometimes gives me this second sort of view of a project in terms of risk. The longer you wait, the more bad things can happen, the riskier the project. If using an engineering economic tool, oftentimes it'll spit out the discounted payback period. So it'll give you the rate of return, the net present value, and then this notion of payback. Not usually used, except if the returns are very, very similar. And you then may want to step back for intangibles and say, well, what's the risk? Is the additional risk worth 0.2% return? I mean, if the answer is yes, well, then you go with A. But it's another way of looking at this. So that's payback for very small projects. The method that will always give you the right answer, where the right answer is the subset of projects that add the most value to the company, the one that raises its share price the most, is this method. And it's not obvious why, and we'll talk about internal rate of return and why it doesn't, but we've really been doing this all along. When we look at any analysis, we're looking at the cash flow discounted at an interest rate. Well, what's specific about this? Still a cash flow, but that interest rate happens to be the cost of capital. So we look at the net cash flows, in other words, F1 through Fn. N is the economic life of the project, which is the economic life, the planning period of the project, which is the economic life of the underlying equipment. And we discount it at the cost of capital. Again, whether the money comes from internal sources and has no cost apparent, or whether we're going up to the market. Doesn't matter. K is the number of value. And it's a very simple equation. Take the present value of those cash flows, subtract the initial investment. So I is simply your cash flow in the year zero, and F1 through Fn, the net cash flows over the project. Now, from a strategy point of view, you have to consider whether your projects are independent, whether they're mutually exclusive, or whether they're mandatory. Okay. What's relevant here is independent and mutually exclusive. So if I have projects coming from all over the company that have no interrelation, I can take whatever subset I want. I want the subset that maximizes the value of the company. I'm just going to take all of those that have NPV, net present value greater than zero, and reject anything that doesn't. If they're mutually exclusive, competing alternatives to do the same thing, just take the highest NPV, and I'm done. And so my cash flows will essentially be the investment, project start into year zero, and R minus C, revenue minus costs on a pure cash flow basis throughout the project. Economic life of the asset here, 6 years, and I'm done. Okay. Now, or actually, I should say, standard planning period, 6 years, and if I have an asset that has a longer life, I'm going to have to estimate the salvage value. Okay. Now, why does this always work? Okay. Well, think about the discount value here, the discount rate, or in other words, the cost of money. When we looked at that equivalence analysis, we were measuring what a person can do with the opportunity cost investment or what the project itself would do. And the key thing is that if I look at the future value here, well, I'm not sure what that Greek letter is up there, it should be 3 dots. William's not projecting some symbols correctly. So those are plus 3 dots plus. What we're doing essentially is valuing the cash flows. And so alternative to this is to future value it to see how wealthy the investor will be. Okay. And underlying that will be this rate of return of K. And what the assumption is, the cash flows can be reinvested at that rate K. So the reason this always gives you the right answer is because we're using K as the interest rate. And I hope that will become clear when we talk about the internal rate of return when we don't use that rate. We use a higher rate, which is not achievable. Okay. So the key thing to remember about this, it gives you the right answer because we're using the cost of capital as the value. Implicit in this formula, and it's not obvious, is that when a cash flow comes in, what's assumed is that you will reinvest it at K. That's a great assumption because the projects that come to the company in years 2, 3, and 4 will likely be above the grade K. And if not, return the money to investors. K is the opportunity cost that they have. They can generate that value. So what's implicit in here, it's not obvious, is that reinvestment occurs at K, which is achievable. And that's why this method works. I'll come back to that when I look at internal rate of return, because that assumption is broken in that method. Okay. So what do I have here? I've just got a bunch of cash flows, and just to show you that we've got an end of year 0 negative cash flow, and we have revenue and cost each year. What can we do? Well, initially we can look at the present value of each option. And so all we're doing is looking at net cash flow, our present value factor, at the cost of capital 10%, and a valuation. And from this I can say that project B is better than project A. Okay. So if they're independent, I'm going to recommend both A and B both have NPV greater than 0. If they're mutually exclusive, I'm going to say that B is better than A, and therefore I'm going to choose B. Okay. So essentially, that's the algorithm. Now, if the problem had given you some depreciation information, $100 and $150 for these two pieces of equipment, it's still not relevant. Right? This is not a cash flow. So it's quite possible you'll get information, revenue, cost, and depreciation. Ignore the depreciation. So it's not a cash flow. So these are the cash flow important parameters of this problem. Now, sometimes you want to save a little bit of work, and you're just going to look at the difference. Okay. So look at the incremental view. Okay. Because in this course, incremental analysis has always been very, very useful. If I ask the question, what's the net cash flow difference between the two projects, which is A minus A, or sorry, B minus A. And so I'm going to come up with the net cash flow difference between the two, and I can value that. So if I have a number that's 103 or 103,000 for this project difference, can I conclude anything from that? Well, the rule is, if the net present value is greater than 0, it's a good project. Okay. So from this, I can say Plan B is better than Plan A. Right. Well, hopefully, if it's a similar thing, that 103 is simply the difference between these two alternatives. Okay. Subject to rounding. Okay. But can I recommend B? Well, look at this. If I have no additional information and this is all the work that you've done, the only thing I can say is B is better than A. I can't recommend B. Just think about if A is really a dog and its NPV is, let's say, minus 500. Well, B is not worth doing either because B is going to be, minus 400, 397. Okay. So I can't tell from the incremental analysis whether or not to make the recommendation because I know nothing about it. Is there any time when I can simply do B minus A and make a recommendation? Hopefully everyone agrees that just doing this is not enough for me to make the recommendation that B is worth doing by itself. Any situations where I can do this and make the right answer? What do you think?
Doing nothing is not an option.
Where doing nothing is not an option, right? Let's say A and B are two versions of pollution control. And I have to do one or the other, or I go to jail. Well, do nothing is not an option, right? Therefore, I'm going to look at the option that's better. I'm going to take the cheapest one, unless the more expensive one has a greater net present value. In other words, spending the additional money will save me money over the long run. So in a mandatory situation, mandatory project situation, I can do an incremental analysis. If the number is positive, then I choose B. If the number is negative, then I go with A. Okay. If it's a mandatory situation, I'm probably going to lose money anyway, and I just want to lose at least some of the money. Okay. So incremental analysis, if you see a question that's mandatory, well, it'll save you a step. You don't have to individually evaluate them. So we'll keep that in mind. For mandatory projects, we're just going to choose the best one of the two, whether it's worth doing or not. Okay. Now, it doesn't matter whether we use present, future, or annual worth in any of these analyses. And oftentimes, if most of your data, let's say, is in annual terms, you may not want to convert everything to a present value. In either case, you're going to make the exact same recommendation because of this concept of equivalence. Because the only difference between these three options is a P given F, or an F given P, or an A given P at the interest rate that's being used at 10%. They're all equivalent. And so, basically, just the nature of the problem or the nature of the data will decide you from a strategy point of view which one you might choose. The only exception to that is if you have an economic life problem, you can only do it meaningfully with an annual worth approach. Okay. So annual worth is good for economic life problem. But by and large, what we will do is the present value of engineering projects. So present worth and present value is the approach, that first one there. So we value everything at the time T equals 0. Okay. But they're all equivalent. Okay. Okay. Now, let's now talk about a very, very popular method that may not give you the right recommendation, but nonetheless it's very popular. It's called the internal rate of return, the IRR. Okay. And what is the IRR? Well, there's a very technical definition. Take my project cash flows, okay, and the investment, and define an interest rate that we don't know, K star, as the internal rate of return. The internal rate of return is simply the solution to that equation. Nothing more, nothing less. It's a number. Okay. So get your cash flows from the project, which you'll know your investment, and solve that Morrill equation. It's just like a bond deal. Most of the time it's trial and error and then interpolation. And you get K star. That number is always correct. It's a number. Solve that equation. The problem comes in when you now make a leap of faith and say, that is the rate of return on investment, which is a very logical conclusion. Okay. Because I've got some interest rate here and I've got an investment, therefore it must be the rate of return on investment. So if that's what you're saying, it may be misleading. But the answer, of course, is correct. It's a number. Solve that portion. We can use the internal rate of return usefully, correctly all the time in certain conditions. Okay. Now remember, net present value, if it's greater than 0, it will add value to the company. Now, I can always say that if the internal rate of return is greater than the cost of capital, so these are the symbols here, K star, IRR, K is the cost of capital, remember that weighted average cost, debt and equity. I can say if K star is greater than K, NPV will be greater than 0. I can always say that. Therefore, IRR and NPV will give you the same accept reject decisions. When do I make those? With mutually exclusive projects. All I want to know is, are they worth doing? Okay. Your problem comes in when I have projects that are not mutually exclusive. Excuse me. Let me state that again. If I have independent projects, all I want to do is choose that subset that are greater than net present value greater than 0. So if I have K star greater than internal, K star greater than K, I can choose all of the ones that have that condition. The problem comes in if I have to rank. In other words, with mutually exclusive projects, I've got 4 of them, and I want to know which one is number 1. If I have 21%, 20%, 19%, 18%, you would think that the 21% project is best. Well, it's not necessarily. And so if I'm ranking, or if I can't choose all of the independent projects because I don't have enough money, then implicitly I'm ranking, I have a problem. NPV will give me the right answer in that the highest NPVs are worth doing, but the highest internal rate of return isn't. And let me just show you an example of where that is the case, and I'll talk about why. And hopefully that will make NPV more clear in terms of why it always gives you the right answer. Okay. So this is just, okay, so I'm just going to do this, just some numbers, like plan A, plan B, and then I'm just solving these 2 equations, so just a bond yield type trial and error and then interpolation, 40%, 44%. So what I can say is, if the projects are independent, I am absolutely guaranteed that both projects A and B are worth doing because my cost of capital is 10%. That's always correct. However, because 44% is greater than 40%, if I'm simply using the IRR method and no other information, I'm going to say that B is better than A. I'm not necessarily guaranteed that the net present value of B will be greater than the net present value of A, which is a problem if I have to choose between the two. I know that the net present value of both will be greater than 0, because I'm guaranteed that from the method. But I'm not guaranteed that this guy will have an NPV greater than 0. I'm sorry, will have a net present value greater than 5 A. I want to make sure that that's the case. So what I'd like to do next day is I want to show you an example where I'm going to look at these cash flows and I'm going to make a recommendation in terms of one versus the other to the internal rate of return. And then I'm going to ask the question, is that the most valuable project? And then we'll talk about, well, why that may not be. Okay, thanks.
下午还去上课，现在我走了。哎，46预计，上有点收益。啊？上有这么收益？对啊，哪来的？你录的呀！我操！我这现在不是46亿啊？对啊，怎么可能录像啊？我一直是。